Okay, today we are going to be speaking about Elliot and also about Fibonacci. And there is a reason why I have connected them both because um, there is a need for proportion in markets, and markets are a lot about symmetry. And symmetry can be equality, symmetry can also be something more than equality. It is mainly about proportion. Um, this the Elliott wave is an old theory which came in 1930s, but the story or the real work started much earlier by Charles Dow. Charles Dow was the person who actually wrote the Dow theory. And okay, you cannot hear me. Let me increase some volume. Okay, now is it better? Okay, so Sergio, we should reconnect. Hello. Okay, so some of them are saying it's okay, some of them are saying it's not okay. Mm, Let me see if I can. Hmm. Okay, so maybe you all can see if there is some adjustment because some of you are saying that the voice is fine, or we are on a good volume here, so maybe it's some browser issue. I don't know. Okay, we'll start because we're already 15 minutes delay. So the idea of Eliot was very inspired by Charles Dow, and he studied his work. Many market technicians and many market um, analysts have been studying old theories, and Dow theory is a very old theory. So 1930s, 1920s was the time Elliot took fancy to the stocks, to the stock charts, and that's when he was studying the Charles Dow theory. And the Charles Dow theory is very simple. It broadly says that the market moves in three broad trends. There is a three stage growth that happens in the market. Charles Dow was born in 1851. He created the Charles Dow Index in 1884, and uh, and Charles Dow also saw the market patterns, and that's why he wrote the Dow theory. And this is a price structure of the market from 1857. And 1857 was a war low, and then 1861-65 was the Lincoln time, and 1877 was the time when Mr. X and Miss Horton were creating indices. And indices was a new technology because the stock markets were new, and there was need for financial innovation. And Axe Horton were the one who were compiling indices. They were playing with creation of averages, and they were also maintaining some data, and these indices were called the Axe Horton indices. So prior to Charles Dow, these Axe Horton indices were compiling historical data. So as you can see that the price structure or the formation of uh, the market or the data or the prices nearly formed a five-wave structure which had three stages of growth. So this three stages of growth was what also impressed upon Charles Dow, and when he wrote his Dow theory. So as you can see, there was first stage from 1857 to 1864. Then there was a fall from 1864 to 1877, rise from 1877 to 1881, fall from 1881 to 1896, and then final rise into 1929, where we saw the big crisis. So this consistent structure, which was happening again and again, was the basis of the Dow theory, and Dow was the one who formalized it, and he broadly said that the market moved like waves. There was there were some small wave structures, and when it comes in the ocean, there were some ripples, and then there were larger waves, and then there were tides. So he said there were many small activity that happened in the market. Then there was some serious activity that happened in the market, which he called as waves. And then he said the tide was the one which really caused the change in trend. So this is how he saw nature in the stock markets, and this was 1884, where he was connecting the nature with stock markets. Now, like 150 years later, we are still trying to understand how markets and nature is linked. But he was the one who said it in 1884, that he gave a like analogy to the stock markets, and he actually wrote down time duration in terms of how these structures should be. So he said that the smaller price behavior, say less than 3 weeks, could be called as minor, and more than 6 weeks time frame could be called as intermediate, and more than 9 months could be called the primary structure. So the primary was the one he said was the trend. Intermediate one, he said, were serious activity which caused some price action, and minor, he said, was a lot of noise which may or may not be causing the trend. So he said that if somebody had to understand the market, had to integrate these 3 degrees of time frame, that is minor, intermediate, and the primary structure. So he also explained that in this three time structure of the markets, there were also 3 stages of the market. So there were 3 time structures: smaller structure, medium structure, and larger structure, minor, intermediate, and primary structure. And along with this time structure, he said there were 3 stages. The stages were like this. Phase one was when the large investor, or the contrarian investor, comes in and he believes that markets are valuable, and that is when he starts buying, and he has got deep pockets. He has an ability to spot value. He has done it on prior occasions, or he is generally a risk taker who believes that this is a good time to buy. Now, 1932, at the uh, depression low, seems to be the worst time to buy, because it's after the crisis, and it's lots of jobs have been lost. People don't have food to eat. There are bankruptcies, and that point of time, the the bottoms are formed, and those are the time where the large investors come in. So then, after the market starts to base a little, bottom a little, the market fails to make a new low. So this can be easily seen as an example of Betfy or local markets here. We have seen a 90% crash. Now, 90% crash was a time where there was more selling pressure than more buying interest. At 90% lows, if some investor comes in and he buys because he believes that the sentiment has exaggerated, that's the time he may buy, and that could be called a phase one, or an some investor stage. And the speculator stage is when the markets really trend. So from me, if markets go, say, start going above change per me and those as the me, that's a kind of real trend that can be established. And then finally, we can say that the there is a final factor, say till from Optesh Pemi or from Chinch Pemi to Tre Chinzami or Tres Demi. So that is the final stage when everybody is interested. Now, I'm just trying to give you an example how it is connected, though this is a much larger time frame because it's from 1975 to 2000, but I'm still talking about a three stage of the market structure. And there could be a larger stage also, and there could be smaller stage, but the holding period are broadly uh, defined by the Dow theory, which says that less than 3 weeks is minor, more than 6 weeks is intermediate, more than 9 months is the primary structure. We have been rising from March 2009. If we reach March 2011, which is about 24 months, and 24 months is 2 years, and 2 years is a primary structure according to Dow theory. Now, these are only guidelines because there are very few rules in the market, and even when we will speak about Elliot, you'll see that there are only few rules. But the guidelines say that more than 9 months is a primary structure, and this could uh, this could last for a few years. So, if it lasts for a few years, this is another structure of Dow Jones that I've drawn, that I've illustrated here. But the point I'm trying to make here is that apart from the wave structure or the ocean tide ripple wave structure, I'm also explaining a three-stage psychology. Three-stage psychology is very important because three-stage psychology is as connected with the three-stage of nature that Dow illustrated. The three-stage of psychology is smart investor, large speculator, everybody. So these are the three different extremes. So there is a panic at the bottom when the large investor comes in, and there is a euphoria at the top where everybody wants to buy in. So this was the three-stage theory Charles Daw wrote, and he made some rules also, which were linked with volume and which were linked with price confirmation and which were also linked with time. But what Elliot did was that Elliot said that Dow theory is great and Dow theory has a pattern, but this pattern of three stages and three holding periods and the psychology is not just on a certain time frame, it is on every time frame. So he said that it is not just about Sutre Saptaman plus Shasa Saptaman plus No Loon. It is at 1 minute, 60 minute, 30 minute. It is at every degree. So he said at every degree of price, at every degree of time, there is always a three-stage structure. A three-stage structure on an intraday level where somebody buys in at the start of the panic low. There is a market has been falling, and Monday morning the market makes a bottom, and there is somebody who comes and buys in. Then there is still fear in the market. Market fails to make a new low and continues to stay above the previous low, and then the market start to go up, and that's the time the large speculator starts to get interested in, and there are large volumes which come in to buy. And by the end of the day, market has gone up 3%, and people start to get excited, and many people buy in. And then the next day, the market may come down again. So this is a very simplistic explanation, but this is what Elliot said, that Elliott wave is a Dow theory or a three-stage of market at every time frame. So he said that the 1, 2, 3, 4, 5, which Dow explained as a market structure which has three up legs and two down legs, can be drawn on any price structure on a shorter